Fibonacci. In this topic, we're going to be discussing a special tool that allows us to predict whether a trend is about to continue or whether it's about to reverse. Let's put these topics down. So the Fibonacci has two settings, or two ways in which you can set it up. One is using the Fibonacci Retracement tool. So retracement. The other feature is using the Fibonacci Expansion or Extension tool. In this case, let's call it the Extension tool. So these are the two types of Fibonacci's that we're going to be discussing. The first type of Fibonacci, the retracement tool, helps you predict when the market is going to continue in a particular trend. So this is trend continuation. Okay. It also assists you with expansions. So expansions help you predict when the market is about to change direction of trend, or what we call reversals of trend. So reversals. Okay. Now how you can picture a continuation of a trend. Let's say the market goes up, comes down, and goes up again. So clearly we're already in an uptrend over here. So the Fibonacci can be applied by simply dragging it between the point where the trend started and the point where our resistance came in, and it will then help you identify the next buying point where we expect the market to continue going up from. So since the market is a buyer's market, if you use the retracement tool in a buyer's market, it will help you identify the buyer. The extensions or the expansion side of it helps you predict when the market is about to change in direction. So let's say the market here has been going up. So it's clearly showed us that it wants to keep going up. By applying the Fibonacci retracement tool also to the point where the market started, to the point where the market started reversing from, and also a third point, which means your second buyer. So once you have these three pieces of information, the Fibonacci will then help you predict where the market might possibly stop and start reversing from. So these are then known as your reversals. So that's what the Fibonacci is going to help us do. So let's get more practical. Let's see how this thing looks and how it's going to help us do this. So let's zoom out here. So down here I've got the two types of Fibonacci's. The first type, I'm going to write it in blue. This one here is known as your retracement tool. And this is the tool that assists you with predicting continuation. The second one here, I'm going to write this one in pink, is your Fibonacci extension tool or extensions that helps you predict when the market is about to reverse. Now, like I said in the first example, in order for us to actually predict when the market is going to continue, we need 2 points. The first point is where the whole trend started. Let's make this a bit thicker. So this is where this whole uptrend started. So from here, market is moving upwards. The market then moved up, found a small resistance here, then found another buyer over here, and continued going up, then found a much bigger resistance over here. So we're going to call this point where it started point A, and we're going to call the point where the market started reversing in a big way point B. So what we're looking for is a point called point C, and according to the Fibonacci, this usually happens between the 50 and 61. So it will happen either by the time we touch 50 or by the time we touch 61, which simply means that the actual trend, so the trend here is moving upwards. It went from A all the way up to B. So A will then be known as your point 100 and B will be known as your point 0. So the market is then retracing, right, pulling back, it's going backwards, and we are measuring how far this retracement will go. So according to the Fibonacci, the market will trace all the way down to the 50 or 61 area, which is also known as your Fib zone. Go check this out, just Google Fib zone, you'll see a lot of this. Right, so the market will retrace down into the Fib zone area, where it will then find, so we're predicting that it will then find a new buyer within this. So a buyer can come out here. Let's use blue for this. So the buyer can come from here, so we can find support here, or we could find support at the 61. It really doesn't matter, it's one in the same area. So what we predict is that the market will then move from here, get to the 50 or 61 area, and then start pushing back up and continuing the trend. Okay, by understanding this, we actually found point C, and then the market will then move all the way past point B, so we break in resistance to go and create point D. This is basically where two theorems cross paths. So we've got a group of people known as harmonic traders that believe this theorem, that the distance that we travel from A to B should be the same distance that we're going to travel from point C to point D. So basically this whole distance that we travel from A to B, so from 100 to 0, is the same distance as we should cover from point C to point D. And that's where the rule comes from, and this is how you take your profit. So instead of feeling like you missed out on a trade because it left you as it moved from A to B, relax and wait for the market to then retrace back into the Fib zone, where you can then pick it up, because that's where we're predicting that the market will start continuing from. Now, looking at Fibonacci extensions or expansions, this is at the point where we've already found point C and we're trying to predict where point D is going to happen. So point D will happen at a point where the market might potentially start changing direction and moving back down in the case of the uptrend. But if it was a downtrend, point D will be a point where the market will then decide that it's moved down long enough, so this will be point D, and then the market will turn from there and start going up. So point D is a point of reversal, and that's what we're talking about, and the Fibonacci expansion is here to help you understand that. So in order to use the Fibonacci expansion tool, we need three pieces of information. In the first one, we only needed to find out where A and B are. In this case, we need three pieces of information. We need the first buyer, in this case, right, which is point A. We also need the first seller, which is then your point B. And then we need to already have a second buyer, which is then your point C. So you need all three of this information before you can actually use the Fibonacci extension tool. So basically, the Fibonacci will then extend out and show you the possible resistances. So these are all resistances: resistance, 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 resistance. So it's predicting where the market might happen. So D can happen here, D can happen there, there, or there. So what we're pretty much predicting is that the market might continue going up from this point, hit the 161 area, and then start moving down from there. Or it might continue breaking the 161 level, might have a retest, continue going up to the 261, get there, and then reverse from there. Or might also decide to break the 261, bounce here, retest, and then go to the 423, get to that level, and then finally make its reversal. So this basically helps you see the future before it happens, future resistances, future supports in the case of a downtrend. So in this case, we're predicting that D can happen anywhere between these levels, and that's where the market might want to now start creating a brand new trend where the market might reverse. Okay, so let me explain it a bit better here. So here we've got a retracement of 50. So basically what happened here is the market started here at point A, and it rapidly just started moving upwards. So you couldn't catch this, and it finally found a resistance here at point B. From this point, then the market started moving back down. At this point, this is when you then took the Fibonacci retracement tool and put it at point A, which was then the 100, and point B, which was then the 0. And we're hoping that by the time we get to the fib zone, which is then down here, the market will then continue going up. And as the market came down, did its thing, it hit the fib zone at the 50, and then the market from there started moving up. So according to the harmonic team, we just discovered point C here. Okay, we should then see point D at the same distance we traveled from point A. Should be the same distance we traveled from point C to point D. Okay, so since point A to point B is 100%, this would mean the fib extension 100, this is where the 100 is, this is the 61.8, this is the 161.8, this is the 261.8. So there's another level higher on called the 423.6 level. Okay, we'll see it as we look at more examples. So basically we're expecting that because of this theorem, D will at least happen at the 100%, because A has to be equals to C, AB has to be equals to CD. So we expect the market will continue, go beyond resistance B. Okay, because we're in an uptrend, we expect it to go higher than they are already. So we expect it to break resistance here and continue going higher. So the market will continue going through the 61, and when it gets to the 100, this could potentially then be our point D because of this theorem that states AB equals CD. So the market could easily then just turn from there and start moving down, and this trend could come to an end. Alright, but D could also happen at a much higher pricing, which simply means that when the market gets here, it can then move down back to the 61 and then crack this resistance level or break it and go to the next level, which is then the 161 level, and then decide to turn from this level and break this trend and continue going downwards. Right? And you can clearly see that the trend has been broken. If you connect point A to point C, because these are your two buyers, this is how the trend would look. Okay, very simple. So we had buyers every time. We touched this average here. Okay, let's see right here when we created this new buyer here, and finally we broke out over here. So I think it's actually coming together. You can actually see how the retracement tool and the expansion or extension tool come together. So we use the retracement to find continuation of market, and we use the extension to figure out where the market might start turning from. Okay, so I think that's pretty obvious at this point, or you kind of understand what's going on here. So let's scroll down and look at some examples. At this point, we're looking at the Fibonacci retracement. Okay, and we're looking at it from a point of a downtrend market, so a down moving market here. So this is retracement. And here on my right, we're looking at the expansion or extension tool. So we want to know how far that trend can go. So this will then be your point A. This is then your point B. The market then started moving upwards from point B towards the Fib zone. So this area here is your Fib zone. The market then went and touched the 50, went a bit higher. We thought it might get to the 60, but didn't. And the market then continued moving all the way down to go create point D, because this is point C. So D will happen at the same distance that we covered from A to B. So let's draw it in here. So let's go to shapes. The distance from A is up here all the way to point B, which is then down there. So if you take this line, let's make it, if you drag this line from point C, so C happened at the 50 area, you realize immediately that point D would have happened right over here. So this is the 100%, which is point D. And you can see if you look to the right here that the 100% level is literally right there where I drew point D. So this is the A, B equals C, D rule already being applied. At this point, point D has already been created, and we expected that the market will turn here. So now we can then start applying the Fibonacci extension tool, because we have all 3 points that we need. We've got point A up here, we've got point B here, we've got point C here, and the market already moved all the way down to point D. So potentially the market could have taken this support here and reversed and went all the way up. But the market decided, you know what, I'm gonna break this 100 point, retest it. So here we broke it, then we retested, then we continued going down to the next level. And the next level there was the 161 level, where the market broke down a bit, played down there, but finally broke up, retested, found an actual buyer or support, and the market then officially took a U-turn. So it reversed here and then started moving up from there. So here we officially identified a reversal. Okay, reversal at the 161 level. So you can literally see the two tools coming together, and they're literally trying to do the same job. One trying to show you how to continue with the market trend, and the other one trying to show you where to reverse the market from. So I hope I really broke down Fibonacci in a nice calm way so that you are able to use the tool yourself. Obviously we're going to look at some examples in future videos. At this point, I hope you understood that AB equals CD because of the harmonic, guys, and you can use these two tools to help you predict very crucial information like continuation and reversal. So drop me your comments below. Let me know if you now feel like you need the Fibonacci in your trading system if you're not already using it, and if you're already using the Fibonacci, let us know how you're using it. Leave us your recommendations down in the comments as well. So until we meet in the next video, peace.